What is double entry? Well, it's definitely one of those things that stress a lot of accountants and future accounting experts out, but it doesn't have to. Today I want to show you one simple way to remember what to debit and what to credit. Are you ready? Okay, let's go. Let's look at double entry made simple. If you're looking at this video, be sure to invite a friend to join us study online, or to encourage them to follow us via IG or Facebook, the Accounting Academy. Don't be selfish, share the information. So double entry is a bookkeeping method that keeps a company accounts balanced. It helps shows a true financial picture of the company finances. Credits to one account must equal debits to another to keep the accounts balanced. Now this causes a whole lot of stress, right? There are a few golden rules which we're not going to go into because I want to keep it simple, and I want to show you how one simple rule can help you ease all that double entry stress. And the one simple rule is on your screen, right? One simple way to remember double entry rules. All you got to remember is dead click. Debit expenses, assets, and drawings when you want to increase them, and credit liabilities, income, and capital when you want to increase them. So dead click tells you what to do to increase these type of accounts. And obviously, if you know what to do to increase it, then all you got to do is to do the opposite to decrease it. Yeah? So remember dead click. That's all you need to remember when it comes to double entry rules. Debit expenses, assets, and drawings to increase them, and credit liabilities, income, or capital to increase it. That was easy, right? Yeah, that's it. So let's look at a question quickly. Prepare simple T accounts which shows the effects, the debit and the credit for each transaction. Now we're going to leave out one because one is a little bit complicated. We're going to look at that last. Let's look at number 2. So we have some accounts on our screen. We have some T accounts on our screen. And the first question says, receive $4,000 cash from a customer named John Chu. So we receive money from him. That means cash is an asset. If we want to increase cash, all we have to do is, according to dead click, debit that asset. So you're going to put the 4,000 under the debit side. Lovely. Nice. Now we receive the cash from someone we have to pay back. And that now is a liability. And we know to increase liabilities, we have to credit according to dead click. So you're going to have to put the 4,000 under the credit side under the John Chu account. Simple, lovely. Now we have paid rent of 10,000, and I'm going to use via check. So I have my rent account and I have my bank account. Rent is an expense, and we know according to dead click, we debit our expenses when we want to increase it. So 10,000 is going underneath the debit side of your rent account, and 10,000 is going from your credit under your credit side under your bank account, because bank is an asset, and if we are paying rent, that means our asset account is going to decrease. Yes, fantastic. So let's look at question 1 and question 4 quickly before we wrap up. If you guys want more information, you want more accounting stuff, just follow us at the Accounting Academy on Instagram and on Facebook. So we sold goods valued at 3,000 and received 2,000 by cash and 1,000 by check. You're not going to see a sold good account. You're not going to see an inventory account, but you will see the sales and a purchases account when we're dealing with inventory. Right? So sales and purchases, those are basically our inventory accounts. So we sell goods valued at 3,000. Inventory is an asset, and if we're selling goods, that means our asset account is going to be decreased. Right? So according to dead click, when we want to decrease an asset, we credit it. So we'll be crediting sales. We're going to be getting some money in our hand. Yes. So we want to increase the cash account, which is an asset. So we're going to debit that. How much are we going to debit? Because it is a bit of a complicated question. We are going to debit cash with 2,000, but now it's not balancing because we have 2,000 cash, we have 3,000 sales. The next 1,000 has to go into your bank account. We have to debit bank with $1,000 because the customer paid by check with $1,000. Yeah, so that's it. Really, really simple. Just using that click, you know what to do to increase the accounts, and you just do the opposite to decrease the account. Purchase vehicle valued at $50,000 and credit from Exquisite Cars Limited. We purchase a vehicle. Vehicle is an asset. Okay. So if we want to increase the vehicle account, we're just going to debit vehicle with the value, which in this case is $50,000. So under your vehicle account, you're going to have $50,000. Who are we crediting? Because we must have a credit once we have a debit. We are not crediting cash or bank in this case. We are crediting Exquisite Cars Limited. They give us the car on credit, which means we didn't have to pay right now, but we will have to pay them back. That means we owe them, and a liability is something that we owe. So if we want to increase our liabilities, in this case, so we're going to credit Exquisite Cars Limited account. $50,000, and we're going to debit the $50,000 on the vehicle account. That's it, guys. Just use that click, and accounting double entry is going to be very simple for you. If you love this, let us know in the comments. Give us some emojis. If you are interested in our free guide to move from transactions to trial balance quickly, type me in the comments and we will get that to you. So that's it from our accounting stuff. Follow the Accounting Academy, and until our next video, remember, take account of what you have in your hand and use it to your advantage. Until next time, bye guys.